Big man team. Yo guys, FFX, welcome back to another video. Today I'm gonna be showing you key ways or simple ways in which you can involve yourself within the markets. In other words, different types of entry approaches, high probability and highly effective entries, right? So yeah, all of this is gonna be based on the shift of market structure, meaning that as soon as all confluences for you to execute a trade based on whatever model you work, I'll provide an example on how I approach it, right? You'll be capitalizing all of this based on time, price, and profile, and even pattern, if that makes sense. So yeah, we've got like two charts right here. Within this one, it's just an example of bullish price, right? This one is an example of bearish price, right? So there's different types of ways or different types of entries that can be utilized within this range to go long, and there's different types for bearish price right here. So the first one, right, it's going to be a classic breakout, right? So maybe price is drawing lower, it reached your PDRA, your higher time frame PDRA, right? So let me just add a highlighter and let me see how the laser looks. Yeah, so price is going higher, draws back lower, right? It breaks out, closes above the breaker block, and this becomes a breaker block as soon as price closes above, well, at least to me, right? So that's your breakout entry, right? These ones are usually the highly favorable ones, but at the same time they could prone a lot of drawdown. In other words, you'd have to have tighter stop losses, wider stop losses, meaning that when price draws back, you generally want to place your stop below the low right here or within a lower range, because we got other PDRAs within this range in which price is 9 times out of 10 gonna drop back into. The first one being our fair value gap, the second one being an inversion fair value gap, third one being an implied fair value gap, right? So that's simply the first phase in which we execute utilizing this, right? The second one that is pretty much my favorite, and I'd assume 90% of ICT traders, if they're not into auto blocks, they most likely trading based on this, right? And that is our fair value gap entries, whereby now price creates a breaker, closes above the range. That's usually how I set to trade, right? I'm comfortable with price as soon as price closes above. Currently learning on how to refine that, right? But yeah, so like now when price does that, we initially wait for price to create some form of a fair value gap and then draw back into it, right? And then push above with a stop loss still at the same zone, right? Or if you want to have a tighter stop loss, right, we have a fair value gap below this one right here. Since this one is a busy buy side imbalance, sell side inefficient, right? Even the one below is, right? So like when we utilize this one, which should be the one we should always trade, right? The first one or the closest one to our breaker range, that's the one we want to utilize, right? As soon as price taps its high, right, you set a limit order, a buy stop or whatever for high prices, but your stop loss should allow price to weak through this fair value gap range to potentially draw to the one below it. You understand? So in this case, generally your stop would be below this candle low, and if you want to be safe, still below the low, right? The third one is our inversion fair value gap, which is pretty much a fair value gap from a previous price distribution range, meaning that it's a bearish fair value gap turned bullish, right? And this is evident as soon as price closes above a fair value gap, right? This bearish fair value gap, CB, sell side imbalance, buy side inefficient, as soon as price closes above it, it starts supporting higher prices. Therefore, price creates a breaker, right? Draws back into the range, it'll highly react off it. Same way here when we have bearish price, right? Price draws higher, creates this fair value gap, draws lower, closes below it, right? This becomes an inversion fair value gap, therefore it's supporting lower prices. price drops back into the range, reacts, low prices, right? The fourth one is our classic order blocks, which most like using. Personally, I'm not really a fan of them. I just mark them out on higher time frame as PDRAs, right? Because usually within order block ranges, there tend to be other types of PDRAs on lower time frame. Therefore, potentially within this range right here, there could be like an order block. I mean, fair value gap or an inversion fair value gap or whatnot, right? So if you want to refine price, right, generally your order block would be the last down close candle before the bullish move, if that makes sense. But generally, when you want to be safe, right, you would mark out executive down close candles within this range as your order block range. Then when price draws back into them, this high right here. Some utilize the body, some utilize the wicks. Personally, I utilize the wicks. If I was to enter, I would utilize the wicks because more often than not, it's gonna react off there, right? But the rule is with order blocks, right, you generally do not want to see price close below 50% of the bodies. In this case, that is called the mean threshold, right? But when we have a large order block like this, I would personally refine it to a smaller range, if that makes sense. Whereby now, from this high to this low, this is my true order block range, and I do not want to see price close within the mean threshold, which is 50% of this candle body wise. If you're bearish, 50% of this bullish candle body wise. I do not want to see price close above that or below this one, right? So right now, I'm going to be providing you my personal way in which I would approach this, right? In this case, we're looking for a classic AMD profile, right? Accumulation, manipulation, distribution, right? And how I personally utilize it, I look to see price sweep previous session highs and lows, right? But there's specific ways in which I want to see price sweep it, right? I usually want to see it sweep the previous session low, right, within the second or third quarter of the next session range, right? And this is evident by us dividing a full 24-hour range New York time into quarters, right? Then our first quarter would begin at midnight, or let's say our first quarter would be Asia session, so it would be 6 p.m. all the way to midnight. Our second quarter would be London from midnight to 6 a.m. Our third would be from 6 a.m. all the way to noon, 12 o'clock, right? And then our fourth, which is being the PM session, would be from noon, 12 o'clock to 6 p.m., right? So I generally look, if I was trading London, here's what I'd be looking for. I'd look to see price sweep Asia low, right, within Q2 or Q1, right? Then draw higher. And if you pay attention, Q3 is generally our trading kill zone, which is from 2 a.m. all the way to 5 a.m. And then our kill zone would be generally from 3 a.m. all the way to 4. I think it's a 60-minute window, right? So generally, you want to see price sweep sell side below our silver bullet range, right? And then react higher. If I was trading this during New York, right, I would look to see price sweep London high or London low, being in case London was a manipulation and then New York becomes a distribution, right? So it becomes a reversal of London, right? I'll be making weekly profiles based on that in the future. Just hit me up on the comment section if you want to see that, right? So I would want to see price sweep the Asia low, the London low, accumulate within the first quarter. The second quarter would be my manipulation, therefore sweeping London low. Then our distribution would be within our silver bullet range within the third quadrant, right? Which is silver bullet entries would be within simply 10 to 11, that 60-minute window. But I tend to refine that to just trade in the whole third quadrant range, right? So if you want more details about that, right, you can just check my previous videos. They'll be explaining everything specifically to the peep, so you'll pretty much understand what I'm talking about when I'm talking about Q1, Q2, Q3, right? And in simple terms, it is always nice to see when price draws lower after sweeping a previous session high or low, right, to draw into a PD array, right? What do I mean by PD array? In this case, it would be a D array. P stands for premium, D stands for discount array. So price would be drawing lower, sweeping sell side, drawing into a higher time frame or current time frame PD array, which would be a fair value gap, an order block, a rejection block, even a breaker block, right? So there's multiple ways. The ones usually I actually recommend, the easiest one to see, right, that's the one you want to be using, if that makes sense. So within this distribution range, right, this is what you'd be utilizing as your entries. This right there, right? So this is the profile. This is the profile in simple details, right? This is the previous session low, which would be this blue box low, right? So this could be London session for New York entries. This could be Asia session for London entries. This could be New York session for PM entries for features. This could be the PM session, though, if you're trading Asia for Sydney session pairs like yen pairs, and right. And if you can pay attention, the profile that I'm simply specifying, right, is the same as the market maker two-phase distribution model by ICT, right, whereby price sweeps sell side, right? This is my specific of how I approach this, right? It goes higher, it creates some form of a range, and then it distributes lower, right? In my case, this range is our accumulation range. When it draws lower to target sell side, right, that's my manipulation. And then within my distribution, which is in the third quarter, right, which is within my previous video, if you want to go watch that, that's where we want to see displacement. So in simple terms, we generally want to see two types of sell sides sweep. Accumulation low, we want to see that sweep, and our previous session low, we want to see price sweep that, right? And then within this range, we wait for a breaker, which we can utilize as an entry, right? We wait for a fair value gap, an order block, an inversion fair value gap, then we can capitalize on that, right? And it's always better when you're looking for this profile to pretty much form on correlated markets. For example, if you were trading Forex, you'd want to see this pattern visible. If you're trading Euro USD, you want to see pretty much the same thing on GBP USD. In other words, they should be supporting the same price direction. In simple terms, if you are long on GBP USD, you should be long on Euro USD, right? Heading into features, if you are long on S&P 500, you want to be long on Nasdaq and US 30, right? So when you are long on DXY, the dollar index, you want to be short on Forex pairs, Forex asset classes that are in correlation with that, right? And also, if you're trading features and you want to set up you want to get the highest probability bias, right? For features and Forex, they should be in inverted correlation with the dollar index. What do I mean by this? If the dollar is bullish, Nasdaq, S&P 500, Euro, USD, GBP USD, they should be bearish. They should be the opposite price direction. And if they're not doing that, then chances are they are ranging or decoupling, right? In simple terms, decoupling is when price correlated markets stop being correlated. You generally want to avoid trading conditions like that, because those are usually low probability trading ranges, right? But went off topic with some bombs in it. But yeah, this is how typically price would look, right? In this case, sell side, we got sell side here, which is Q1, and my Q1 would be Asia, right? but in this case, this is intraday price. So therefore, this pattern is pretty much universal to quadrants within price. Therefore, this whole pattern, I can look for it within Q1, Q2, Q3, Q4, right? Okay, in this case, price accumulated. We'll pretend this is our Asia range, this is our London trade. Price accumulated, right? This range, sorry, boy, got a sneeze in it. Accumulation, though it may look as a full impulsive move, right? It's within Q1. So Q1 is always accumulation. Price accumulates, price opens within the next session, it accumulates again. Second quarter, price distributes, sweeps, sell side, it draws back higher, provides us displacement right here. Displacement being our breakup block. As soon as this candle right here closes above this high, that can be capitalized as an entry if there are not any visible PDRAs within this range, right? Because generally, out of all those that I've provided, only 3 to 4 will be present. For example, if you pay attention, within this range, we do not have an inversion fair value gap. We do not even have a fair value gap. We have an order block and a breakup block. So those are 2 PDRAs you could pretty much capitalize on, right? So price breaks out, that could be your entry, right? And your draw on liquidity is the accumulation range high, right? It's the accumulation range high because that is our true range. When price manipulated, it's drawing back to our accumulation range, right? So it should pretty much look like something like this, right? And this is like pretty much something I'm looking for each and every single day, right? And this profile tends to be very, very high probability when it's in sync or in correlation with high time frame bias and market correlations, as pretty much every model or every form of price action is, right? But yeah, hope you found this video insightful, man. I know I would, because this is pretty much helpful. But yeah, if you liked it, just smash the like button and hit the notification bell for next video, because I will be releasing that soon, right? But just also provide me a video on what you specifically want to learn based on ICT concepts and how I personally utilize them, because every approach is unique to every ICT student, right? But yeah, man, hope everybody stays safe.